Hi there, Internet. My name is ʀᴇᴇᴜ and I'm one of eToro's most copied popular investors. Friday means a weekly update. So, without wasting more time, let's get into it. Okay, it's been another frothy week, but let's start with my stats. So, the S&P 500 is my benchmark. The S&P 500 didn't move very much this week. It lost a little bit of a percent in terms of its year-to-date gains. So it's sitting at 4.2% in terms of returns for the year from the 1st of January. To contrast my performance with this, I am up 10%. So I've also had a bit of a frothy week. I've lost a little bit of a percent too. Looking at my returns in eToro. So these stats haven't updated just yet, but this will drop back to maybe 1.5% based on yesterday's trading. So that gives me my year-to-date return. My 6-month return, I've created a little bit of a website that I will be adding to over time. So you can see my year-to-date, 6-month, 1-year, and 2-year returns here. So lifetime return is over 650%, which I think is pretty good. And so 10 grand invested in me from 2015 would now be worth £75,000. And if I'm able to maintain my annual returns that I have had for the past 6 years, the average return, which is more than 35%, by 2025, your 10 grand would be worth £288,000, which is not too shabby. Right, enough about stats. Let's see what's going on. For those that have been following closely, you will have seen me buy quite a range of stocks and ETFs through the past week. And this is because I have 4 strategies that are in play. And these strategies have different time frames, by the way. So the first is that I think there will be a bounce in tech stocks. I think it will favor things like big tech more than other tech, probably. So you will have seen me buying a little bit more of the FANGs, as an example. I do have slightly more speculative plays, or maybe a lot more speculative plays that I've been picking up, but they are much smaller than the others that I've been adding to or building. The second play that I have going on is value. So the rotation to value continues. So if we jump out here, this is the 1-month view of which stocks and sectors have won and lost. And you can see definitely things are moving into value and defensive stocks. I don't think this is done. I think it will continue. I think it might continue for months. It'll just might be happening to a lesser degree. So I've been adding to my value positions and picking up other value stocks or defensive stocks for that play. The third strategy that I have going on is inflation. So this is US inflation to date. It's picking up speed. The Fed seems to be downplaying inflation a little bit. They do see it rising to 2.4% by the end of the year. It could be even worse than that. I think this forecast, by the way, this is the range that it could play in. I think this forecast is probably off. So I've started accumulating inflation hedges, sometimes in the form of, for example, gold miners. And the fourth strategy that I have in play is the opening up those recovery stocks. The world is worried about recovery, particularly in Europe at the moment. There have been issues with the vaccine rollout, vaccine supplies. So the world opening up seems to have been, it will be delayed. And the market is scared about this. The thing that I like is that the UK has done pretty well in terms of our vaccine rollout. So I've still been buying UK recovery stocks. The market seems to have forgotten about these. They're taking a breather after having a fantastic 2 months. But I've been accumulating these a little bit more as the market dumps, which is good for us. Okay, some of the themes for this week are the same themes we've been seeing for ages. So inflation on the back of treasuries. So the 10-year yield, oh, this is the 1-minute chart. The 10-year yield spiked quite a lot through the last week. By the way, rising yields don't necessarily scare markets. The pace at which they rise can scare markets. And this has been interpreted as the market saying inflation is going to rise faster than the Fed thinks, and the Fed is going to have to raise interest rates faster than it says. So, I mean, we'll see. But the way that this typically plays out is that yields and inflation, they might spike, but they typically will kind of plateau and maybe drop off even a little bit. Not every time is the same, but that's typically what happens. So we will find out. So bond yields, that has been a big theme for the past week. And even though the Fed spoke, gave an update this week, it was highly anticipated. The Fed has said that it will continue QE at the previous rates, at the current rates, that they think they're going to keep the interest rate at the same level, near zero, through 2023. And the market initially celebrated this when it happened. I think it was Wednesday evening. And there was a massive risk-on attitude, and we saw indexes and cryptos flying. And then the next morning, the market woke up and they decided they didn't like that news anymore. Actually, that signaled that inflation was definitely going to increase rapidly, and the Fed didn't know what it was talking about, and it wasn't going to keep rates flat through 2023. It was going to raise them, and so we've seen a sell-off yesterday. Pretty aggressive sell-off yesterday. This has impacted the Nasdaq hardest. So if we look at the Nasdaq 100, whoops, I think this column is the 1 month. This is 1 month and year to date. So the Nasdaq is sitting at a loss for the year, and for the past month, it's not looking pretty great either. Other countries have taken their cue from the US. So Chinese tech has sold off in tandem with US tech. I hold a decent amount of Chinese tech, and this has been one of the poorest performing areas of the platform. Of our portfolio. This doesn't worry me too much, because even though Chinese tech is selling off with the Nasdaq, it doesn't make a lot of sense actually, because Chinese tech stocks, at least the ones that I've bought, are incredibly good value, and so ultimately I expect them to appreciate quite nicely. Within the Nasdaq and the Nasdaq 100, it's the speculative stocks that have hurt the most. When I say speculative stocks, I mean the stocks that have just been bought up. The meme stocks form part of that. So for example, GameStop has seen a decent sell-off in 1 week, but also some of these other high-flying stocks that have been multi-baggers through the tail end of last year and even through some of this year. So we're seeing these get impounded. I don't think we'll see, once the rotation is complete, I don't think we'll see money rushing back into these stocks very quickly. Some of these companies are fantastic companies, but they were massively overpriced. And I think the world will feel safer investing in the likes of FANGs throughout this year. Eventually, the risk-on attitude will return, and these will have a run again, but I don't think that's going to happen for a while yet. The Bank of England also had their meeting and gave us their update, so no surprises there, except that they think that the economy is a little bit stronger now than they had initially anticipated. I've already spoken about the rotation, which is over here. If we look at the one-day performance, it's not as obvious, because when the sell-off in the Nasdaq is really aggressive, that selling kind of spreads to other sectors. You can still see it a little bit, but it's nowhere near as obvious if you were to compare it to the 1 month view, as an example. The pattern that we're seeing is that the Nasdaq is selling off more than the S&P 500, which is selling off more than the Dow Jones. And so if you are interested at all, you might want to take a look at things like the Dow Jones components, because all an index is a combination of stocks, a basket of stocks. Now the Dow Jones has some fairly big technology companies in there, so these have affected the rise, but there are also a lot of defensive stocks in there, and these have helped it lose less, and in some cases even rise on some days. So the Dow Jones and the S&P 500 have been hitting new all-time highs, for those that haven't been watching very closely. All right, so oil was shattered yesterday. It had an enormous one-day drop, so it's up today. I anticipated some kind of a rebound, which usually happens when there's a massive sell-off. But if just take at the side, look at the size of this candle. This is because of a few things. The rise in oil, the price of oil has been incredible. You can see from here. I mean, that's a crazy amount, several 100% since April last year. And this rise is because it was at a silly level before, but there's an anticipated increase in the demand for oil as the world opens up. We need more oil for flights and cars and whatever else. But this drop off, I think some of this will have been profit taking, but also it'll have been fears about an oversupply, particularly because a bad rollout of vaccines means a world that opens up later than we had been anticipating over the past few months. So the demand for oil will still arrive, but it will arrive later than anticipated. And when oil sells off, all the related industries sell off. The energy industry sells off, even if things within the energy industry aren't really related to oil. So you'll have seen even like solar companies will have sold off. They still have some reliance on oil to make some of their parts, but they will have sold off more than they should have, which is usual. The market is irrational. I also wanted to highlight something that I've been thinking about recently, which is loss aversion. So loss aversion is quite interesting. As humans, we've evolved certain ways of thinking, and some of these ways of thinking were very good when we were hunter-gatherers, but are actually pretty bad if you let them control the way you think or control your strategy while you're trading. So we, as humans, we feel losses more than we feel gains, sometimes up to twice as much, and this drives us to do strange things. So try to be aware of our own psychology and how it might affect you, so that you can potentially dismiss it if you think it is driving you to take actions that you shouldn't be. All right, so for the coming week, I have spent some cash, but I still have quite a lot of cash on hand. And this is because I can't time the market. I don't know if we're going further south from here, and I want some what we call dry powder in case there are some great opportunities that I need to take advantage of. I've deployed a fair amount of cash through the week because some of the things that I have been buying are good prices, even if the market does go further south, and eventually we will benefit from them. It does feel as though the Nasdaq has probably put in a bottom. I'm not sure if we will retest this bottom. It's not impossible. Don't be afraid of me saying that, by the way. But it feels as though we're probably somewhere in the range of a bottom now, even if we do retest. And we're in a consolidation phase, which is good. It's healthy. You want the market to get comfortable with a certain level before it takes the next leg up. The media, I mentioned this earlier, but the media seems to have forgotten that the UK has done a fantastic job at rolling out vaccines. And this means that if we take a look at them, some of the recovery stocks that we have, they're doing okay, but they've been beaten through this week. So EasyJet, I guess, is down because the world is worried about the vaccine rollout in Europe. But there are lots of companies that are a lot more domestic, and their stock prices have also been falling. I think media attention will swing back to recovery stocks eventually, but for now, this creates a pretty good opportunity for us. And there have been a few earnings that have happened through this week. So Wetherspoons, National Express, and those are UK companies, by the way, but also one of my favorite companies reported, was it last night? The night before? Wednesday night? Canadian Solar. This is by far one of the cheapest solar stocks out there. And their earnings results were pretty damn good. Their guidance was also good, so the stock rose off at the back of that. But what we also need to keep an eye on is upcoming earnings. So earnings in the US will start kicking off now. and then really gain speed through early April. So the market will start turning their eyes to earnings to determine the direction that the market takes. I don't know which way earnings will go on aggregate, but we will see. All right, that is it for today. I know that these periods of volatility and frothiness can be a little bit alarming. Try not to let it worry you too much. This is a natural part of the market. In fact, this type of consolidation makes me a lot more comfortable. When we have an extended bull run, that is when I become really uncomfortable and start getting really worried about the short-term future of the markets. Okay, that's it. Have a great weekend, get some rest, and I'll see you next week.